Good afternoon and welcome to this week's edition of Halftime Talk. I'm delighted to be joined this week by Sara Emerson, the President of Energy Security Analysis. Probably a good week to be talking a little bit about energy security. Welcome, Sara.
Thank you. It's lovely to be here.
Sara, I want to start with the inevitable sort of news of the day, if you like, and that is the big traumas in the Middle East, and looking at it sort of through the prism of the energy markets. A little bit surprising how little the energy markets have been disturbed by this major event, obviously grabbing every headline in the world, and yet the oil markets are sort of dismissing it as a non-event as far as they're concerned. Your thoughts on those two things? Major geopolitical event, oil markets say, eh.
Well, I think the oil market's response makes a lot of sense. We've seen absolutely nothing that would impinge on oil flows. I think the only thing you could connect to the oil flows would be if the escalation, if there was an escalation in the conflict, which moved the conflict largely out of Gaza, and potentially more with Hezbollah, and potentially more than with Iran having more of a role. So, or Israel feeling that Iran was going to have more of a role. So we're just not seeing that escalation in that direction yet. But even if you did, even if there was some sort of conflict that allowed for the sharing of dropping missiles or something between Israel and Iran, it doesn't make sense for the flow of oil to be shut down in the Gulf, because Iran exports through the Gulf, and all the other producers export through the Gulf. So it's just not, it's not like 1973, when you had a lot of other things happening too.
But we did see after the Ukraine war started, the Russian invasion of Ukraine, oil prices jumped quite dramatically up above, I think they were cruising more or less where they are at the moment, and then went a big spike up to 130 or more, and then obviously in the subsequent weeks calmed down again. On this occasion, we just saw sort of a few dollar bump and nothing much more.
Well, in that case, there was a much stronger expectation that Russian exports of oil would be interrupted.
Right, and clearly the shock there perhaps is that they haven't been. In the context of this moment and where it leaves the supply threat, which you've obviously highlighted there, where does it come at a moment from a demand point of view? Because I think perhaps there's two sides to the narrative here. Clearly supply is not disrupted, and there's a lot of idle supply in the world at the moment with a lot of cuts from OPEC plus. But on the demand side, is this also falling into a weak moment, and hence the price is not overreacting on the upside? Your thoughts are from a demand point of view of the timing of this event.
Well, let me start by saying that I'm not sure the supply capacity is that ample. Obviously, you have the volumes that the Arab Gulf producers have cut back. So yes, there is that capacity sitting on the sidelines, if you will. But there was a reduction in Russian exports by over 1 million barrels a day. And so the European refiners are out there looking for additional oil to replace that still. So from a crude demand perspective, it's a little bit tighter market than I think people are aware of. But you lay on top of that the fact that there are so many economists and market watchers who believe there'll be a recession in one or more countries, or that even we are at the beginning of a recession already. So I think there is sort of expectation of weakness in demand, and there's a odd balance on the crude oil side. So it's you have two different forces here pushing the market. And also, I must say that when we follow oil demand really by product, by country, and it's been really fairly robust. I mean, it's definitely decelerating now, but we have no indication that it's going to drop dramatically. So there's a lot of different narratives shaping the market right now.
the recession that never comes. I mean, in ultimate sense, it's been the year in which the recession never came. The boy who cried wolf, or whatever analogy you want. Having said that, obviously the Fed are meeting this week. The trickle down impact of 500 plus basis points over the last year are finally starting coming home to roost a little bit when we see non-performing loans and in mid-sized banks in the United States. Are we finally going to get that sort of kick from the economic downward draft on the back of these Fed hikes? Is that day going to arrive, or is it still going to be a false dawn into the new year, you think, in terms of give up crying recession?
It's none of us really know, do we? I think one of the things that's very interesting about the discussion of recession is the definition of recession used to be 2 quarters in a row of contraction. And now the definition is a little bit more generic. It's sort of several months or a few months of very low economic growth. So, if you take that second definition, yeah, I think we could get there. Whether we would have a 6-month contraction, hard to say, but we certainly are slowing down. Another variable is, student loans in the United States are no longer, you now have to pay your student loan. You no longer have that opportunity to delay your payments. So that's another impact on consumer spending, which of course is, in the U.S. economy at least, is really, really a big factor. And now you have, the housing market slowing down because mortgage rates have gotten over 8%. So there's a number of indications that we should have a slowing economy here in the US. At the same time, we have China slowing. So I think the IMF pegged them at 6% in 23 and 4% in 24. And then on top of that, you have a very weak Germany. So we definitely seem to be
I mean, it is kind of amazing with all of these sort of macro headlines that are not new, obviously, from the point of view of the trajectory of travel, and yet oil demand remains and in its post-COVID recovery of 102, 103 million barrels a day. And even in this sort of anemic economic macro posture, that number doesn't really shift.
Not a lot. So last year, 23, I call that last year already, but this year, oil demand grew at about 2.6 million barrels because Chinese growth was about 1.8 million. So we had a very, very big kick up in demand this year. Obviously, Chinese growth will not be that high next year because a lot of that was, bouncing back from the lockdowns, adding jet fuel demand, adding some more gasoline demand as people were allowed to drive. So we actually see a fairly significant deceleration, but I think it's well known. I mean, I think everyone thought 23 was an extraordinary year for China. So now we have demand decelerating quite a bit, but there's still consumption that just has to happen. So you're not going to have you're not going to go down to zero. You're going to go down to about 1.5 million barrels a day. So that's still fairly healthy 1%, 1.2% growth.
And that would be easy, I suppose, relatively easily met with Venezuela coming back now. It's obviously the Saudi voluntary cut still there. Let's look a little bit at the Latin and at the Americas, and starting with the US itself. We're seeing recently these fairly significant mergers, or with sort of more acquisitions, really, by the majors of the big actors in the Permian Basin and the shale production of the United States. What's your take on that? And what does that signal moving forward when the big sort of 10,000-pound gorillas now are controlling the shale patch?
Well, shale is more, as you know, is more of a manufacturing industry than it is a long form sort of 20 years of production kind of industry. And so frankly, we've had M&A since shale began. So it was, medium-sized independents gobbling up little independents merging to become bigger. And so now we have a period where costs are up because of the supply chain issues and then now inflation. And you're seeing bigger and bigger players gobble up bigger and bigger, fish, so to speak. So you've got something like Pioneer, which is a very big independent all by itself. and Exxon. And the same thing with Hess. Hess is a good size independent, and now Chevron is taking over Hess. So it's kind of the continuation of a trend. We're just getting much bigger numbers. And to be fair, the top 10 producers in the Permian, which is where a lot of this activity is taking place, still only produce about 60% of the market of the Permian Basin. So there's still probably a lot more consolidation coming. But you get that when you have high costs.
And in terms of the outlook there, when you have the likes of Exxon and Chevron control, and Oxy obviously before them, when they acquired, who was it they took? Pioneer? No.
That was
I forget now. Anadarko, was it?
Anadarko. You're right.
Anadarko, yeah. Ultimately, their ability to ramp up production, or the opposite thereof, in essence, they can restrain that supply piece, which obviously has a great impact on, because the Wild West days of all those tiny producers was, of course, what took us from 6, 7, 8 million barrels a day in the US to 13 or whatever it was, 5+ million barrels, because of that maverick gold rush. And now that that's over and you've got the big players controlling on a much bigger matrix, you would say that the upside probably going forward will not be anything like that.
The upside for prices, you mean?
No, the upside for production. The idea that because what I'm saying is the outlook, because of this takeover by the majors, they've obviously been enjoying the realization in the last few years by OPEC Plus, that you curtail supply, prices go up. You give money back to shareholders, prices go up. You don't put money in the ground. When you do, prices go down. So ultimately, their control of the shale patch now, I think, is generally more bullish than bearish, as it would have been if all of the little players were still in charge.
Yeah, I would agree with that. Yeah, absolutely. The consolidation into bigger companies, you're bringing a better P&L to the development of shale. You're bringing more cash. So yes, I would think by this consolidation should probably result in continued growth in Permian. And obviously we might even see a little growth in Bakken with the Hess acquisition. But yeah, I suspect we just have stronger players now in the Permian.
Bigger players. When we look at the wider sort of pitch of the Latin, obviously the big news recently, Venezuela opening up, or some détente, if you like, between Washington and Caracas on what's being permitted there from a sanctions point of view. How do you look at that, both from a production, obviously oil in the market point of view, but also from the geopolitics? Where do those two things, what do they tell you about what's coming?
So from my perspective, I think the Biden administration wants more oil in the market. I think they're more concerned about capacity constraint than declining demand. So I think they will do what they can to allow more oil to get to the market under these sanctioned companies, except Russia. And so they are sort of turning a blind eye to.
I mean, ultimately, they gave Russia the big green light, didn't they? I mean, it was the administration who did the oil price cap that was a way of kind of fudging the Europeans' drama about cutting off Russian supply, and ultimately ensured that it was going to get to market. I think Biden loves Russian oil.
Yeah, I actually, you're absolutely right. The price cap was a loophole in the sanctions to allow more oil to flow. And the general license that the Treasury Department has given to allow both, production, exports, sales, and investment in Venezuela is kind of the same idea. It's a quid pro quo. The Maduro administration has certain targets it has to hit, although those have been not really defined, very explicitly. And now producers that are already there can sort of begin to go back in with cash and labor and equipment and begin to, remediate a really damaged industry. And that leads to your second
The fact
question.
that it's only 6 points, there are 6 months, the fact that this is a 6 months limit and then renewal, I suppose, does that impact the momentum of the speed in which companies would go back in, or how do you read that?
It's a good question because some people look at that and sort of say, well, if it's only 6 months, I don't want to allocate capital to that. I don't want to go in and do that kind of investment. But you remember, you've got these joint venture partners that already have a foot in the door, like Chevron. I think Chevron alone could probably add another 100,000 barrels a day by the end of next year. And then you've got Repsol and Eni and a handful of other companies, Morel and Prom, and those companies could probably get in there. They already have some action going. They're already producing a little bit through the JVs, and they begin to sort of, debottleneck, repair, and you get a little bit more crude. So I don't think you'll see outsiders rushing in, but I do think that the JV partners that are already there will certainly bring a little more cash to the table, I would guess, and a little bit more labor and equipment. So our projection is they get about 200,000 by the end of 24, and maybe another 200, 250 by the end of 25. So it's still very small numbers. And that's assuming it gets renewed in April.
When you take that sort of prism in which one would say Biden likes more supply, and obviously it's an election year now. We're not quite 12 months, but a few days away from 12 months till the election. What does that say vis-a-vis Iran? Because Iran's probably been the biggest benefactor this year of sort of not lifting of sanctions, but sort of ignoring of sanctions and allowing a lot more oil come to the market. How do you see that playing out? And what are the election dynamics that sort of throw up for Biden?
Well, almost every additional barrel that Iran has exported this year has gone to China. In fact, perhaps every single barrel at this point. So it's not
And a lot
easy.
of them into their inventories.
Exactly. So it's not easy for the US to impose secondary sanctions on China. It's just not a country that we have that kind of power over. So it's been, maybe a little bit of a, we're not really sure what we can actually do. We don't know if we want to fight that battle now. With China, we've got so many other issues with our rivalry. So, let's kind of ignore it along the way. By feeding China, it frees up maybe some other barrels from the Middle East to go to Russia, to go to Europe. So I think it's an easy one for them to look the other way. And I'm sure they're following this in great detail and pretty intently, but it's just, is it something we really need to address right now? And I think they've decided no.
Well, it's interesting that Amos Hochstein, who was the kind of Iranian sanctions czar in the Obama administration, is now the point person on Middle East oil diplomacy. when Iran has been able to essentially export every barrel they can, it's kind of an interesting political dynamic for it to be a possible question in terms of an election cycle that Biden is soft on Iran. Is that a narrative that carries much water in the U.S. election cycle? I don't know.
I don't think, how narrative works in the United States. It's what each party wants to make it. So I think among the voting public, they haven't noticed this at all.
Right.
So it's up to the Republican Party to hammer this point if that's what they want to do. And if they do hammer it, then maybe it's a point for them. I don't know.
The flip side of that, of course, is the price at the pump. In
Exactly.
terms of just sort of wrapping up around this question of peak oil demand, of course, we've had this, the IEA come out with a fairly robust declaration in the last month that 2030 would to be the sort of before 2030 we'd see peak oil demand, peak all hydrocarbon demand, and in the back of the month since we've had we've had all these mergers in the Permian, and we've had the sort of OPEC come out and say, what a load of nonsense. There's an increase of 6 million barrels a day of demand over the next 20 years. Your thoughts on what the divergence of those major agencies, what it tells you? Which one do you follow? What do you read from it?
Well, I think both organizations have slightly different perspectives on what's coming sort of over the horizon. And that's fair. I mean, none of us know exactly what's coming over the horizon. And so they have different perspectives. And I think they're engaged in a little bit of a healthy debate. So when the IEA says demand's going to peak very soon and start falling, I mean, not everyone believes that. and OPEC comes out and says, well, no, we actually don't believe that. Here's an alternative view. And then folks look at the OPEC numbers and say, well, not everyone believes that. So I actually think it's a debate between two organizations that have a different perspective, and have a different sort of interpretation of what's going to happen in the next 5 to 10 years as the energy transition begins to gain speed. So I actually think it's a healthy thing, because as long as you've got multiple points of view, there can be more debate on, well, how do we get to the next step of the transition? So.
I suppose the big question mark that it might deliver is, what impact does it have on financing of new capacity, as banks and the money has to fund, hundreds of billions of dollars of new investment in hydrocarbons, and you've got a major OECD agency saying, well, actually, hold on a second, that stuff might be extinct by X date. So anyway, that's up for debate. That's lots for discussion. Sara Emerson, President, Energy Security Analysis, thank you so much for joining us on Halftime Talk this week. Really enjoyed it.
Well, thank you. I did too. Thank you very much.